Okay, so welcome back to this next video. So we already know that we have the current account where we account for goods, services, investment income, and unilateral transfers. And then we have the financial and capital account where we have direct investment and portfolio investment. And here I want to give you an interesting example just to close with this topic, and that might help you to differentiate between financial and capital or current in a very specific situation. So imagine that the situation is that an American person is buying shares from BMW. I will continue. So that transaction, when the American person buys shares, only that transaction, when the American person pays for the shares, it will be classified as financial or capital account. Why is that? Because it is part of portfolio investment. It's an American person buying shares from a German company. So that will be the how do you classify that transaction? And you will classify it as debit from the American perspective because the money is leaving the US. But then what happens if BMW pays dividends to the holders of their shares? So that means that Germany will send money to the US. They will pay dividends to the American citizen. So in that case, it will not be financial or capital. It will be investment income. So it will be current account. This is an interesting example that you have to be careful about, because the first transaction when the person buys the shares is financial or capital because we're talking about buying the shares. And then when that share produces income, it will be part of the current account. Be careful in there. Another example that is similar to that one. Imagine that an American company builds a factory or a branch in Germany. Again, this is a similar example. That will be classified as direct investment debit because they send money to pay for that factory, and it will be financial because it's direct investment. And when that factory produces some income or they gain profit from that and they send the profit back to the US, it will be investment income. Okay. So be careful with that situation. Just think about it about two different stages. Like one transaction is buying the shares or building the factory, paying for that factory. That's one transaction. And the next transaction is getting the profit from that investment. That's why it's investment income. And finally, if I want to make it even more complex, what do you think will happen when the American person sells the shares or when the American firm sells the factory? It will be part of the financial and capital account again, because when that person sells the shares, we are talking about financial assets. So it's also portfolio investment. And when the American company sells the factory, we are talking about direct investment again. And in that case, when they sell, the money comes back to the US and it will be credit, it will be positive. I will explain later on when we do the exercises that thing with credit and debit. But so far, just remember the main differences between current account and financial and capital account. So now I want to do a very quick exercise to explain reserves. So I told you that that the balance of payments is like the accounting of the country. But more than the accounting, I would say is the cash flow, because the cash flow tells you how money leaves your pocket or enters into your pocket. So let's make a quick exercise to show you about reserves and related. So in this example, let's think that we have a current account uh, final account of maybe minus 10. That means that from everything that is related to goods, services, net investment income, and unilateral transfer, this country lost 10 dollars, for example. Let's continue thinking about the US. So in the case of the US, the money from these transactions, goods, services, unilateral transfers, it resulted in a negative number. That means more money left the country. And now let's think about the financial account. In terms of the financial account, let's think that maybe they have a +5. That means that the US received more money in terms of portfolio investment and direct investment. This makes a lot of sense because the US behaves something similar to this. The US is a country where uh, they receive a lot of money from the financial market and they consume a lot in terms of goods and services from other countries. I will explain this in the next videos, but just for you to remember. So if this is the case, imagine that the US spent $10 and they received $5. Where do you think that what do you think happens with that balance of -5? The thing is that their reserves their reserves is like the savings from the country. So if we analyze this like in terms of personal finance, this is something like if you spend more money than the money that you have, you will probably be using your savings, right? Like imagine this month I have to pay a lot of taxes and a lot of things. So I paid, I don't know, 20,000 pesos, but my income was only 10,000 pesos. So that means that I had to use 10,000 pesos from my savings. So it's the same in here. If the US spent $10 and they received only $5, that means that their reserves will decrease in 5. Okay, so far so good until here. It makes sense. I think it makes sense, right? It's very clear. It's if you spend more money than the money that you received, you will have to use your savings. So this is basically reserves. Countries prefer to have the opposite. Countries prefer to have savings and reserves. I will make a special video explaining why is that important and under which systems is more important than on the others. But in general terms, countries prefer to have savings. Same as us, I think, like we like to have savings instead of using the savings. It can be a bad year when we have to use our savings, but it's better if we have more savings. So now let me show you something funny, but that happens. Imagine that this is the case of Mexico, that Mexico has a balance in the current account of -10 and a superávit of 5. A surplus, sorry, superávit in Spanish. So deficit is when you have less money, like in here, and surplus is when you have more money, like in here. That's the technical name, surplus and deficit, and superávit in Spanish and deficit in Spanish too. But imagine that this happens in Mexico, that you have -10 and +5, so your savings should have -5. But imagine that the government takes a look at their savings and instead of -5, they have +5. How is that possible? How did I spend more money and I receive less money? And how do I have more savings? That doesn't make any sense. Well, it is possible. Why is that possible? Because of this. Net errors and transactions. Net errors and transactions are transactions that the government can't account during the year. So during the year, if there is an export, an import of goods and services, the government will notice and will take note of that in the accounting of the country. So maybe if Aeromexico buys an airplane, if an American tourist buys a ticket to Mexico through Aeromexico, or if we have, I don't know, if we buy tools from Europe, things like that, the government will take care of that. But what do you think about the money that Mexico receives from selling drugs, for example? That's why I gave you the example of Mexico. If this is the case, I think the government will think like, the money, we have more money because we sold more drugs. This is because net errors and omissions are usually transactions that the government can't or that the government doesn't account. Usually because they are not legal, that in the case of selling drugs or weapons, anything that it's on the black market, because in the black market, the government doesn't realize about this and they can't account for that. But also, it's another simple example. It's like if you go to the US, maybe you go to Las Vegas and you get some money from a casino, maybe you earn $100, then you come back to Mexico And when you come back to Mexico, you don't report $100, right? Because you are only forced to report $10,000, I think. So you don't report that $100 that you earn in the casino. So that $100 will be part of net errors and omission. Imagine that you come back and then you sell your dollars to your cousin or in the bank or wherever. So you put the dollars in the market again. When the government makes their accounts, it will result in more reserves, and they will say, it's because net errors and omissions. So this will be, in this case, in this example, this will be plus 10 to make it even, right? So plus 5 plus 10, it's plus 15 minus 10 equals plus 5. So it is possible that that can happen. And usually in countries like Mexico, this is quite important. Also in the US, because the US also has a lot of things with the black market. But in other countries, it's also because maybe they can't account for that amount of money. Countries with a lot of tourists, this is also important. So it's also an important account. So just to summarize the accounts, remember we have the current account that is related to goods, services, investment income, unilateral transfers. Then we have the financial and capital accounts when we categorize only transactions that are related to investments. It can be direct investment or portfolio investment. And then we have net errors and omissions, which are literally transactions that the government doesn't know about. But it's very important that we make the reference, or we are clear in this example with net errors and omissions that the money between countries actually moved, right? Like there is a transaction of money. The only thing is that the government didn't account for that transactions. That's the key thing. If you can write that note in your notebook, that's great. Because the difference is that when in net errors and omissions, there is a transaction of money, but the government didn't account for that. Don't get confused, because it's possible that there is no transaction, right? So let me give you an example. Imagine that this is a funny example. Imagine that there is an American tourist coming to Cancun, and he goes for a spring break. And in Cancun, there is a bikini contest or something like that. So that American person wins the bikini contest. So he earns $100. And immediately that person uses the $100 to buy a bottle of tequila. So in that example, there is no transaction of money, right? Because the money stays in Mexico, right? Like the American person comes to the US, the American person comes to Mexico, and in Mexico, that person earns $100 and immediately spends the money in Mexico. So there is no transaction, right? It is possible, because this is like a tricky question that I can make in the activities homework or in the exam or case study, that sometimes there is no transaction of money. So you have to be very careful on finding if there is a transaction or not. Actually, in the next video, I will talk about this, how to classify the transactions, okay? So let's watch the next video. And with that, I think we can finish this idea of classifying transactions, and then the next videos will be about the impact on the economy. Why are we studying the balance of payments for our course? Why do we do that? So let me finish this video and we'll start a new.